So good morning to all of you, and thank you for coming to AXA's presentation on full year 2011 earnings. Presenting today will be Henri de Castries, Chairman and CEO of AXA, Denis Duverne, Deputy CEO, Gérald Darlin, Group CFO, Mark Pearson, CEO of our US operations, and Véronique Weil, Group Chief Operating Officer. A Q&A session will follow the presentation. Henri, I can now leave you the floor.
Thank you, Mathieu. Good morning, everybody. Happy to be with you this morning to discuss the AXA 2011 earnings, which are robust in an environment which has been quite difficult. Why do I think that the earnings are robust and showing the resilience of the business model in an environment which has not been particularly favorable, to say the least? Well, first, underlying earnings are progressing, even if it's modestly. They are progressing, moving to 3.9 billion. If you look at where they come from, you then see first, the diversification of the business model, which is something which is strengthening the group. Second, the fact that these earnings are progressing in two of the key areas of the group businesses, property casualty, where clearly we had a very good 2011, very much in line or slightly ahead of the Ambition AXA goals. Second, in the protection and health segment of the business, where earnings are up 8%. The place where the business has been more challenging in 2011 is the savings and asset management portion of the business. We all know what the volatility has been in the market, what the decline in long-term interest rates has been, what the evolution of the equity markets has been. Their earnings are contracting, but we think that we have there also a solid business model. The other elements I would like to highlight are the fact that operating cash flows are up significantly. They are up 14%. It's one of the points you and us have been looking at very, very closely. It reflects, I think, the soundness of the model. These 4.2 billion are there too, very much in line or slightly ahead of what we were expecting within Ambition AXA. Financial strengths of the group. I'm not going to insist too much on the Solvency I ratio, even if it is still the current regulatory model, but it's at 188, so a very strong and solid position. I'd like to focus more on both the gearing and the Solvency II ratio. The gearing has come down to 26%. It's one of the goals of Ambition AXA to bring it down to 25% in 2015. You see that we are well advanced there. This is the outcome of both the earnings situation and the capital management we have had in 2011. Solvency II ratio clearly has been affected by the market turbulences, but remains at a very solid level. We were at 148 at the end of last year. Has been affected by the decline in interest rates, by the enlargement of spreads, but remains at a very significant and solid level, way higher than where it was back in 2008. And today, of course, it would be significantly above these levels. So it's something we are comfortable to, even if Solvency II is not the current regulatory regime. We think it's a regime of the future. We hope that there is going to be clarity on this regime soon in Europe, and we are very well prepared to operate within it. So the resilience of the business model, the very strong operating free cash flows, and the solidity of the balance sheet allow us to maintain the dividend at 69 cents. It's a payout ratio of 49%. You will remember that we have indicated for years a payout range of 40 to 50%. Usually we were closer to the low end of the limit at 40%. Adjusted earnings this year, and Denis will speak about it, have been affected by some exceptional elements like the Greek write-down, which leads us to move within the payout range. We are at 49%. The dividend is maintained. It's a dividend yield of 7%. We think this is the right decision in the current circumstances. If we look at where are we when compared to our ambitions, to what we had said to the market back in June, you will remember what are the three key initiatives within Ambition AXA: selectivity in the major markets, acceleration in the emerging ones, increased efficiency efforts everywhere. We are delivering on these three pillars, even if the financial performance has been affected by market conditions. The delivery on operational initiatives is there, and I'll say a few words about it. I've already mentioned the evolution of the underlying earnings. On a comparable basis, underlying earnings are growing by 4%. It's below the long-term rate we want to see, but we think that given the market circumstances, it's an honorable performance. In terms of return on equity, we've been affected this year by some exceptional elements, but we remain targeted on the objective of 15% for 2015, and we think that we will reach it. Operating cash flow, which is a point of attention because we've said we would deliver 24 billion over the period. We think we are well aligned with the long-term goals. And on the debt gearing, I already said that we were very close to the long-term ambition. Beyond these numbers, I think it's important to look at the operational initiatives. And I'd like to highlight three of them which are important: reshaping our life and savings business, fostering the P&C profitability, and improving the asset management picture. 2011 is a year where we have progressed on all of these three fronts. If you look at the segmentation of the life and savings business, you will see that we have done what we had said we would do. We are more selective in the generation of the business, in the generation of the revenues. We want to focus on the health and protection business. The APEs in this business are growing 13%. Why do we want to focus on these businesses? Because it's a place where the margins, the new business margins, are high. The new business value there, the new business value margin there are 47%. It's a growing business with high margins. We want to concentrate the savings business more on unit-linked. There, I would say the performance is mixed, but nevertheless solid in a very difficult year. You know what the performance of the equity market has been. We are satisfied to see that the unit-linked business was, in terms of volumes, more or less stable, despite the low risk appetite of the clients, despite the turbulence of the markets, because the fact that it's stable means in the savings business, its proportion in the total of sales is progressing and at a very significant level. It's a business where the margins on the new business are 23%, so a very profitable business. It's good to see it resisting well despite the turbulences. The place where the business has been contracting is general account. Why so? Well, because it's less attractive for the clients with the decline in interest rates. It's also less attractive for us because it's a place where the new business margins are negative given the current level of interest rates. So we try to be selective, therefore we do not push these businesses. And you see that the overall picture, therefore, in the life and savings business is well aligned with the long-term goals. It's working. The selectivity is working. On the P&C side, 2011 has been a very strong year. We had said that the current year combined ratio would be below 100%. We are even slightly ahead of the plans we had. We had said that the total combined ratio would be below 98 and below last year. It is where it had to be, with a reserve situation which is a very, very strong one. And we are confident that on the P&C side, the efforts we've been doing will continue to bear fruit. And it's a business which is largely independent from the market evolution. In asset management, it's a more contrasted picture, but nevertheless, we think moving in the right direction, even if the year has been more difficult than what you could have anticipated at the beginning of the year. Flows at AXA IM have moved from being negative in 2010, largely affected or very much affected by the difficult Rosenberg situation, to a situation today where they are, at the end of last year, more or less break even. AXA IM had a very good year in terms of investment performance in most of its products, very strong one. And the situation in terms of flows is now much more favorable. More contrasted picture at AllianceBernstein, where even if the flows are less negative than what they were, they are still significantly negative, mostly, and Denis will detail that, in the equity segment of the business. The segments which have been developed in the recent years and fixed income are, for themselves, positive. Beyond the operational initiatives in the three business lines, capital allocation has been an area where we have been pretty active, and I would say more active than most of our peers. This capital management has led us to dispose of businesses for a total value of 4.1 billion this year. And these 4.1 billion have been affected either to acquisitions in high growth markets, what we have done with the buyout of the minority interests in Asia, or a smaller operation buying distribution in Turkey, as an example. For a large proportion of the disposals, 3/4 of them, and 1/4 has been affected, 1/4 has been affected to the deleveraging of the balance sheet, which has enabled us to bring the gearing ratio to 26%. If you look at it, was it the right thing to do? Yes, we think it was the right thing to do. You will see on this chart that Asia Life ex-Japan is now representing 23% of the group new business value, so a significant proportion of our business. And it's a growing part of our business because there, the business is growing at a double-digit rate. So it's really very well aligned with the long-term plans, reallocating capital in the areas where we have double-digit growth, mostly emerging markets, but it can also, of course, also be products, segments, or distributions in the major markets which are generating high margins and significant growth. The high growth markets are also an area of development on the P&C side. If you look at what our two growth engines there are representing, you have to add the direct business, where we are a very, very strong player on a worldwide basis, and the high growth market P&C exposure. It's representing 20% of the group, so something which now is comparable to what we had or what we have on the life side. And there, the revenue growth is double-digit or close to double-digit. Emerging countries have been growing at 16%, the direct business has been growing at 8%, and the direct business is a very solid performer because you have simultaneously a significant growth in revenues and a significant improvement of the profitability picture. The efforts we've made to develop these businesses over the years are now really bearing fruit. One word about the third pillar of the Ambition AXA initiatives, efficiency everywhere. You have there a very simple chart we have forecasted to save 1.5 billion between now and 2015. 300 million have been achieved in 2011. So we remain with 1.2 billion to save between now and 2015. So you see that these efforts are really well advanced and well documented. Out of these 300 million, 200 million have been achieved by reducing the P&C and life and savings administrative costs, and 100 million have been achieved in reducing the acquisition expense ratio on the P&C side. The efforts are working there. I'm now going to leave the floor to Denis for a more detailed explanation of the evolution of the profitability in the various business segments.
Thank you, Henri. Good morning, ladies and gentlemen. I will now go into the detailed presentation of the earnings before leaving the floor to Gérald, who will talk to you about the balance sheet. So let's start with the group earnings. The group earnings, as Henri told you, have grown by 2% on a comparable basis. I will not comment this slide in detail, and I will comment the next slide, which shows you a waterfall of what happened in 2011. Starting with the earnings of 2010, we take out the earnings from Canada because, as you know, we sold our Canadian business in September, and the earnings of Canada, being a discontinued business in 2011, are reported in the net income. So we start from 3.7 billion, the restated earnings for 2010, and you see a contrasted picture. As Henri told you, the P&C earnings have grown by 16%, and I will comment later in detail. And asset management earnings have grown by 20%, whereas on the life side, we have the combination of the change in scope with the sale of the Australian business and the sale of the UK life business on one hand, and also a negative impact coming from the US GMXB technical margin, which is a topic that will be commented later as well. Moving to the adjusted earnings, our adjusted earnings went down 15% to 3.6 billion euros, and this is really a function of the net realized capital losses that we incurred in 2011 of 312 million euros against a gain last year of 400 million euros. And here we had both impairments on the equity side, the biggest one being on our participation of 4% in Montepaschi Bank, and a significant impairment on the fixed income side, mostly related to Greece, where we marked down our Greek exposure to 22% of par, and it's an impairment of 387 million euros. So those are the main impacts on the adjusted earnings. Now, the net income picture is also a contrasted one. Our net income increased by 49%, which is a very good result, but it's really two different stories here. The first one is a significant goodwill impairment on the US. And let me pause on this one and give you more explanation. As you know, since 2008, the US business has been a source of concern to us and to you. We were overexposed to the variable annuities. We made a significant loss in 2008 and had to strengthen our capital by $3 billion. Since then, as you know, ahead of the market, we have significantly de-risked our variable annuities, improved our hedging, and diversified our product portfolio. Whilst this diversification has been successful, 2011 was another bad year for our US business, with hedging losses that were half of what we incurred in 2008, but still too high. With the fall in US long-term interest rates, as well as the reduction in lapses in variable annuities with living or death benefits, we have concluded that a reduction of our US life goodwill was necessary. We have impaired 37% of the goodwill, or 943 million euros, which roughly corresponds to the accumulator product line. As our lapses on VAs were coming down, we've also brought our lapse assumptions in line with our current experience. In doing all of this, we believe that we are making the right decisions and positioning the business for the future. Mark will tell you more about our plans for the US business later. So that's the negative. On the positive side, we have the capital gains made on our Australian and New Zealand disposal, a capital gain on the disposal of our Taikang Life shares, and the sale of our Canadian operations. So the disposals represented a capital gain of 2.3 billion euros. And finally, we had a loss of around 200 million euros on our Hungarian bank operations with the impact of legislation and the discontinuation of lending activities. You know that the Hungarian government, after having in 2010 nationalized the pension system, in 2011 decided that the banks would have to accept a conversion rate for the loans made in Swiss franc at the rate of the Swiss franc against the Hungarian forint of 2008. So that's a significant loss for all the banks in Hungary. Now moving to the life and savings business, and starting with the new business picture. Our new business on an APE basis went down 1% in 2011. And this is a contrasted picture with -1 in mature markets, only +2 in high growth market, because even though Asia was up 16%, as Henri mentioned earlier, in Central and Eastern Europe, because of what happened to the pension markets in Poland and Hungary in 2010, we saw a significant decline of 23% of our new business there. New business margins have progressed significantly from 22 to 25%, and this progression is both visible in mature markets and in high growth market, and I will comment that in more detail in the next slides. Looking at the breakdown of our new business, this is something that Henri has commented earlier. You see that in protection, we have a growth of 13%, thanks to strong sales in the US, in France, in Switzerland on the group life side, and in Germany with a favorable change in regulation on the health side. So a very good picture with 13% growth of APE and 47% of new business margin. General account savings were down 20%, and we have a negative margin of 4 points because of the very low interest rates in which we are operating. And we have been disciplined in our production there, and saw a significant decline in France, Italy, and Belgium. On the unit-linked side, where our margins have been stable at 23%, our production was down 3%, and this is a contrasted picture with strong performance in France, Italy, and the US, and Asia, and lower performance in Germany, where we reduced the sales of our variable annuity products, and in the UK, where we are moving to mutual fund rather than unit-linked. On the mutual fund side, you see a growth of 10%. When you look at the figures, you are surprised that we have plus 10% when the absolute number is lower. With the disposal of Australia, we look at it from on a comparable basis. And here, the main point to notice is a significant progress in the UK, thanks to the success of our Elevate platform. Stable margins at 5%. We are happy with margins at 5% because, as you know, these products have a very low capital consumption. Moving to a more detailed look at the new business margin, you see that our new business margin should have been affected by the very low level of interest rates. And this has a 1.8 point negative impact. But we have more than offset that with three elements: positive country mix, positive business mix, which I have commented earlier with the improvement of the share of protection and health, and scope impact. By buying out the minorities in Asia, we are gaining higher margin markets than what we lost with the disposal of Australia. On the general account side, we are not giving up. we still believe that there is a future for general account products, both when we mix them in a hybrid format with unit-linked products, which is what we are doing in countries like France, with a minimum of 25% for a large, vast number of our sales. And in the case of pure general account products, with an elimination of the guarantees, moving to terminal bonuses as we are doing in Italy, or reducing the guarantees that have been existing in the past on those types of products. And finally, I would say that we are in line with what we announced last June. We said that we would invest additional capital between 2011 and 2015, essentially in protection and health, and to a lower extent in unit-linked. We would not invest additional capital on GA savings. We are in line with that commitment. We have invested roughly 400 million euros of new capital during the year, mostly in the protection and health business. Moving to the detailed analysis of our underlying earnings on the life side, I have commented earlier on the scope effect. You see that we had a significant decline of our US contribution of 155 million euros, which was partly offset by an increase in average asset base, an increase an improvement in the mix. The other negative was on the technical margin, where the impact of a change in regulation in France, what is called the CMU levy, and the increase in the retirement age had a negative impact, as well as the negative impact of 64 million of the Japan earthquake and tsunami. So again, a contrasted picture, but better investment margin, better unit-linked fees, lower technical margin, and lower US contribution. Looking at the earnings by sub-segment within the life business, you see an improvement of the earnings on the pre-tax basis of protection by 8%, an improvement of the earnings on the savings side, general account savings side, of 18%, thanks in part to the better claims experience in Switzerland, but even without that, the earnings would have improved by 5%. A slight improvement of the earnings in the unit-linked business, excluding the US VAs, and a loss of 383 million on the US VAs, coming both from negative hedging results and a reserve strengthening on the lapse assumptions, which I have mentioned earlier. Moving now to property and casualty. As we had indicated at the beginning of the year, our property casualty revenues increased by 3.5%. This is the case both in personal lines, with an increase in 3.6%, and in commercial lines. Personal lines first, we had an average price increase of 4.8 points, and there was also an increase in volume with 1.5 million net inflows of both car and motor and households, more than offset by lower average premium because people are insuring less pricey cars. They are reducing the guarantees given the low growth that we are incurring right now in Europe. On the commercial side, average price increase of 2.3% and a more favorable business mix. We present each year to you, each half year to you, the situation on the pricing side, and you see a very green picture, very favorable picture here, with price increasing across the board in personal lines and commercial lines. And in the past years, you were seeing that our price increases were sticking on the personal lines, but we were losing exposures on the commercial lines. Here you see that our price increasing are sticking both in personal lines and commercial lines. We are increasing prices, and we have gained exposures on both sides. This is with the exception of Switzerland, where we see a slight price decrease and possibly a continuation of that trend in 2012, but our combined ratio there is below 90%. Looking at 2012 market pricing trends, you see that pricing trends are oriented positively in most markets, which bodes well for 2012 on the P&C side, and that's good to know. On the revenue side on P&C, you will notice that we saw a slight increase of our revenues in mature markets, strong increase that Henri commented in high growth markets, close to 16%, a good increase in direct at 8.2%. Current year combined ratio at 99.6, an improvement of 2.9 points, so we are below our commitment of 100%. Our current year combined improved by 3.3 points in mature and 4.2 points in direct. We see a slight deterioration in high growth, which relates to both the Thailand floods and also a bad underwriting year in health in Mexico, but the situation remains solid with the current year combined at 100%. Looking now at the reasons for the improvement in the combined ratio, so you see that earnings improved by 16%. Improvement of the combined ratio has been coming from the combination of factors, price increases, lower nat cat costs. The natural catastrophes costed us 0.7% of combined ratio against 1.7 points last year. We believe a normal year would be 1%, so the year was slightly favorable. Cost savings that Véronique will comment on later, lower frequency and increasing severity. So all in all, a good year on the current year combined. We had favorable developments on prior years, less favorable than last year, only 1.7 points of favorable development, leading to 97.9 all-year combined ratio, an improvement of 1.8 points. On the investment side, our investment income was stable at 2 billion euros in spite of declining interest rates. Moving now to asset management. Our average AUM were down 2%, revenues were flat. And you see on the net flows that at AXA IM, we had a continuation at a much more modest pace of the outflows at AXA Rosenberg with negative flows of 5 billion euros, but positive flows of 4 billion in all the other expertise. As Henri indicated to you earlier, we had very good investment performance across the board at AXA IM. At AllianceBernstein, negative flows of 28 billion, but this is again a contrasted picture with negative flows of 54 billion on the equity side and positive flows of 4 billion on fixed income, where the investment performance has continued to be very good, and 22 billion of net flows in alternatives, in liability-driven strategies and other, 22 billion, which is a significant number. When you look at AllianceBernstein, we continue to have significant outflows, but the gross flows have been quite good at 60 billion per annum, and I believe this bodes well for the future. On the earnings side, on the asset management, we see that we have a growth of earnings of 20%. At AB, the earnings have declined by 23% because of lower revenues and lower assets under management. AXA IM saw a rebound of its earnings of 69%, thanks to the non-repeat of the AXA Rosenberg coding error last year, and higher revenues and performance fees. I'd like now to hand over to Gérald Darlin for the balance sheet, and thank you very much for your attention.
Thank you, Denis. Good morning. Let's start with the shareholders' equity. Shareholders' equity decreased from 49.7 to 48.6 billion, i.e. minus 1.1 billion. The main drivers of this change are first the net income for the period at plus 4.3 billion. Then we have the goodwill deduction. You remember I mentioned this already at for the H1 presentations. That corresponds to the Asian minority buyout, where we had to deduct, according to the IFRS rule, the goodwill from the shareholders' equity, explaining a negative of 2.5 billion. Then we have the 2010 dividend and a decrease in net unrealized capital gains of 1.6 billion. Let's have a look now at Solvency I. Solvency I is very strong, close to historical high levels. As you can see, we are at 188%, and explained by positives and mostly coming from a strong underlying earnings performance. Also, it's offset by some movements from the markets. Economic solvency ratio now. Our economic solvency ratio is at 148%, compared with 178, i.e. a decline of 30%. It's quite resilient. It's in line with the level we mentioned to you at the end of September. As already mentioned by Henri, we would be above 150 at the end of January. I would like to remind you that we are comfortable with this level. The main changes are first a negative 15 points coming from credit and government bond spreads, net of liquidity premium. And second, the sharp decline in interest rates explains minus 20. As you can see on the bottom right, the two main sensitivities are coming from interest rates and corporate spreads. Now let's have a look at the debt gearing. Debt gearing went down from 28 to 26%, close to our 2015 target, which is at 25 points. The debt declined from 15.2 to 13.4, i.e. a decline of 1.8 billion. 0.9 is explained by the net cash proceeds from disposal and acquisition, as already presented by Henri. And the rest comes from higher dividends that are coming from that were upstream from our operational entities. You can see that we have an improved interest coverage from 8.5 times last year to 9.1 times this year. Let's have a look now to general account investments. And the invested assets, first let me explain the difference between the total insurance invested assets, which were 441 last year, 467. Where is this difference coming from? First, from positive net inflows. Second, from accrued interest rates. We have a positive forex effect, and we can say that more or less the other markets impact are quite neutral. As you can see, fixed income remain the most important asset class at 82 points. Let's notice that corporate bonds slightly decline. It's not due to disinvestment, it's due to the spread widening. Let's move to the unrealized capital gains. Unrealized capital gains moved down from 6.6 to 5.1. These are the capital gains which are booked on our balance sheet in OCI. First, equities. Equities declined from 3.1 to 0.9. It's important to notice that the 0.9, we are still positive at the end of the year, that this 0.9 billion unrealized capital gains compared to a net equity exposure, you have this in your appendix, of 6 billion. So that's quite substantial. Corporate bonds unrealized gains slightly decreased, and the government bonds increased from 2.3 to 3.1. And at the bottom of the graph, you can see that for sure, and the Eurozone peripheral countries were at minus 0.7, so that means that we have an unrealized capital loss position of minus 0.7, but we are in an unrealized gain position in all other countries. Last, off-balance sheet unrealized capital gains corresponding to real estate and loans, we went up from 2.9 to 3.2 billion euros. Let's focus on peripheral countries exposure now. So first, it represents 5% only of our invested assets. Second, you can see in the last column on the left, you have the gross market value at the end of January, and you can see that with the recovery of the market, roughly speaking, we are not very far for Italy and Spain from the level at the of mid-2011. Next is the Greek government bond. It's been explained by Denis. So we have an impairment, we have booked an impairment on a net basis, net of tax, net of PB of 387 million. It's following a 92 million impairment in the first half, so it's 295 for the second half. So that means that all our maturities are now impaired, so we impaired the totality, and this corresponds to a 78% haircut. Last, the breakdown, you have a breakdown here between domestic versus non-domestic holders of bonds in the peripheral countries. And you can see that the non-domestic represent 55%. 93% of this non-domestic exposure is concentrated on AXA France, on Germany, and on Belgium. So the question is, what is the ALM impact in a stress situation? And that's what we explain in the following slide. So let's imagine an extreme theoretical scenario where the Eurozone peripheral sovereign debt market value would be reduced to zero. In such a case, we would have the flexibility to realize the 6.4% that you have on the left, which correspond to the gross unrealized capital gains. And you can see that this would mostly offset, more than offset, the 5.5% of peripheral country sovereign debt exposure. And as a consequence, when realized, our reinvestment yield would be lower and would be at 3.9%, where the current investment yield is at 4.4%. But even after, in such a stress scenario, we can notice that our reinvestment yield at 3.9 points would be above the average in-force guaranteed rate of 2%, which means that we have this flexibility to absorb potential losses. Let's move to the investment margins now. On the investment margins, they went down from 76 to 73 basis points, quite resilient. And as you can see, that's why our earnings contribution from the traditional savings business is extremely resilient as well, and is up. The spread with guaranteed rates, you can notice, as I explained last year, that we were expecting a decline in the investment income in life from 4 to 3.9, so minus 10 basis points. And you can see as well that the average guaranteed rates dropped by 10 basis points as well. So we have a comfortable 180 basis points global margin, gross margin on the investment business. Let's have a look at the now at 2011, the reinvestment rate, the average reinvestment rate, which is mentioned on the top right, has been 3.5%, of which Eurozone has been 3.9. And now, at the bottom right, you have the current investment policies throughout the group on fixed income. As you can see, we have still an investment in government bonds, 25%. This excludes, there is no more investment in peripheral countries, but the vast majority under the present condition are corporate bonds and secured financial bonds, because on a risk-adjusted basis, that's the type of investment where we get the most important value. As an example, in the Eurozone, presently, the average fixed income investment yield is at 3.7%, and at the same time, 3.7 compared with 3.9 last year. We are dealing with a very long duration, and which means that there should be a low impact in 2012 investment income. Let's move to the embedded value now. Embedded value drops slightly from 34.2 to 31.5 billion. You can notice that the TNAV is slightly up from 14.1 to 14.5 billion. The operating return, 6.3 billion. You have the key drivers on the right. 6.3 billion, that correspond to a good operating return of 19%. explained by the strong life unwind of the existing life EV at 3.3 billion, which is higher than last year, 1.4 billion of NBV, and 1.6 billion other than life underlying earnings. Investment experience, on the reverse, is strongly negative, -8, and it's explained by the decrease of rates, of the widening of the spreads on both sovereign and on corporate bonds, lower equity level, and that's, of course, net of the liquidity premium. As a whole, group EV per share is at 13.5 euros per share. Let's have a look at the free cash flows now. As mentioned already by Henri, we have a strong plus 14% increase on both life and savings that I'll explain on the next slide, and on P&C. Let me explain on P&C. We are moving from 2 to 2.1. That's explained by the higher underlying earnings, a lower combined ratio, and the realized capital gains net of the required capital. The real cash coming at the bottom line, at bottom left, you have the real cash coming from entities at plus 19%, from 2.7 to 3.2, so that's the cash which is upstream from the entities, which means that that's a strong improvement, and the remittance ratio went up from 75 to 76%. Let's have a look now at the life operating free cash flow. Life operating free cash flow is composed of the expected in force surplus generation, which is higher from 3.6 to 3.9. As you can see, we have a stable new business investment with improved business mix. That means that we have the same capital requirement. You can notice -2.2, -2.2. That means that also we improved our business mix in line with our commitment and with our Ambition AXA commitment. Nevertheless, the capital requirements are quite stable. You can see that there is an improvement in the profitability, IRR moving up from 10.9 to 11.5 in line with our NBV improvement. Now I hand over to Marc.
Good morning, everybody. For those of you who don't know me, I'm Mark Pearson, and I took over management of the US business just 1 year ago. Gerald and Denny have already mentioned some of our business metrics. In summary, the year shows strong operating performance, offset by a small number of adverse market-driven items affecting our year-end results. We're pleased with the progress on sales. Volumes, as measured by APE, are up 7% in the year. These volumes, the improving mix of business, and lower expenses helped offset lower interest rates and drove new business value up 15% in the year. Underlying earnings is really a story of two halves in 2011. At the first half year, we reported strong results on the back of benign investment markets, but severe market volatility and low interest rates in the second half reversed these gains and held back earnings. The underlying earnings of $433 million for the year includes net losses of $661 million for market-related items and the impact of strengthening of reserves for lapses in line with current experience. Net income for the year was a negative $475 million, reflecting the impact of a goodwill reduction of $1.3 billion, which I will cover later. Due to these notable one-off items, I'd like to stress that our reported earnings for 2011 are not indicative of our expected run rate for earnings going forward. On the expense side, some success here. Our efficiency programs are delivering productivity improvements, and our cost base is down 11% for the year, largely reflecting reductions in headcount. Okay, let me look into some of these numbers. Firstly, on the sales side, we had a good year. This slide shows the breakdown of our new business for life and savings. Our life business is rebounding with very strong growth of 40% year on year, principally through increases on our third-party channel and success in distributing our indexed universal life product. We're also very pleased that our retirement cornerstone product, which is a variable annuity with a variable rate guarantee tied to the 10-year Treasury, has grown 24% in the year. This is a real good achievement for this new category product in the market. You can see we have lower accumulation sales as we have reduced features and lowered policyholder benefits on this product. Overall, a good mix, as well as volumes increasing on life and savings by 14%. Against this, gross expenses down 11% to just around $1.3 billion. We are well positioned to continue to pursue these growth opportunities as we have the benefit of multi-channel distribution, and it's pleasing to see that AXA Advisors, our aligned channel, is now generating 2/3 of our APE, and that's up from just over 40% in 2007. That's a good number because it offers us stability moving forward. Product innovation continues to be a critical competence in this competitive and risky environment, and our newly launched life and annuity products, which have lower risk and better margins, now represent over 40% of last year's sales. And as I mentioned on the efficiency side, we've good progress here, including a 27% reduction in headcount in the company since the peak in 2007. So overall, strong momentum on the operating side, and our strategy to diversify and improve efficiency is delivering results. Despite the harsh investment environment adversely impacting results, pre-tax underlying earnings held up well at $415 million, although down on the $740 million we reported 1 year ago. Stripping out the impact of investment markets on our hedging result and the resultant lower policyholder lapses, earnings would have grown on a pre-tax basis by 10% in the year, from $1.162 billion to $1.278 billion. With lower interest rates in the year, net interest margin has been squeezed and fell by $17 million in the year. Fees and revenues and other technical margins grew by $153 million, principally through increased unit-linked fee revenues. Expense savings, offset by higher commissions related to asset-based compensation, contributed an additional $79 million to earnings. On the DAC side, net amortization, excluding reactivity to GMXB attribution, was $99 million higher in 2011 than in the previous year. So pre-tax growth of 10% for the year, excluding these one-offs arising from adverse investment market. For 2011, these totaled $863 million post-tax and pre-tax, of which $538 million was as a result of strengthening of reserves for lower policyholder lapses, and the balance, $325 million, arising mainly from charges for higher volatility. In summary, our underlying earnings picture reflects good performance from our core operations, offset by the adverse impact of the deterioration in investment markets in the second half of the year. As mentioned earlier by Denis, net income for the year was a negative $475 million, reflecting a goodwill reduction of $1.3 billion. Firstly, a reminder. The goodwill we hold at the AXA Financial level totals $3.5 billion and results primarily from the 2000 purchase of the minority shareholders of AXA Financial. While we remain optimistic about the long-term prospects of the business, we need to be realistic about how current market conditions impact our value, particularly the value of our accumulator franchise. So we have concluded that it is appropriate at this stage to take a reduction of part of the goodwill that we are holding. This reduction is a prudent decision at this time, as it represents today's economic climate and leaves us with a goodwill asset that is supportable for the foreseeable future across a wide range of different scenarios. We have moved very strongly to de-risk and reduce volumes on our GMXB portfolio for better margins. We believe that this is the right move in these conditions. For example, for the accumulator series sold in 2007, we would have needed 7.8% of any initial dollar investment as capital backing, whereas for accumulator 11, because of the actions we have taken on the less risky asset allocation and less rich features, the initial capital has fallen to 0.2%. This also translates into the reactivity of statutory capital to movements in the markets. And we can see from this slide, for a 100 basis point drop in interest rates, the impact on capital for accumulator 7 would have been 12.1% versus 1.6% for today's retirement cornerstone and 0.2% for accumulator 11. And you can see the same trend for any fall in equity markets. So what are we doing here? Well, we're clearly trading volume for margin and profitability, and we're also writing much less risky business today. And we believe that moving forward, this is going to continue to drive value and reduce risk for shareholders. One final point here, as goodwill is a non-cash item, there's no impact on our statutory financials. Risk-based capital ratios for our US business remain healthy at just under 500% as at the end of December. I would like to give some detail on the charge of $211 million net of taxes and net of DAC relating to strengthening of reserves for lapses on our GMXB business. Firstly, and this is most importantly, reserve assumptions are now in line with 2011 experience. In view of the fall in interest rates and the announcement that the Fed will continue its policy for maintaining low interest rates for the next 2 years, we have moved our reserves from a 3-year smoothing average to now reflect actual lapse experience in the year. As such, the $211 million impact has a one-off element in it rather than a signal of worsening policyholder behavior in the year. Reserves will continue to be based on the projections of different market conditions with different lapse rates according to the in-the-moneyness and policy duration. In terms of sensitivity, if lapse rates decline by 0.5% permanently and beyond what is already projected, the impact on net underlying earnings would be around $160 million net. The other factor on policyholder behavior is, of course, the rates of annuitization. Actual experience to date is significantly below our reserve assumptions, and we do have conservative assumptions here, and we have no evidence on experience to date of any increase in annuitization rates. There's also a natural hedge between our GMIB, the income benefit we pay, and the GMDB, the death benefit we pay, as of course policyholders aren't able to elect both. And just to give you some sensitivity here, if our annuitization reserve assumptions, not the actual experience, but the assumptions themselves, doubled, we estimate the net impact of underlying earnings after this offset, this natural hedge, would be about $150 million. Still staying with the GMXB, we continue to take steps to better manage the risk of our in-force portfolio. In the last quarter, we are the first insurer still in the new business market to stop the practice of allowing additional contributions in the legacy accumulator business. We've introduced the AXA Tactical Manager and the Asset Transfer Program tools to better manage volatility, both within the funds and at a policy level for investors, but also as a means to protect the balance sheet for shareholders. And as a result of a program we've been running for a few years now, we have 65% of account values in passive funds compared to less than 5% in 2007. Our GMXB hedging program was 89% effective in 2011, and we also continue to take opportunities to pre-hedge volatility, which has the potential to improve effectiveness moving forward. We do adopt a very transparent and prudent accounting for our hedging. It is important to remember when comparing us to other insurance companies in the US, we do not use non-performance risk adjustment, or what's known as NPR. This is permitted under US GAAP and effectively reduces the amount of reserves for GMXB business by applying the company's own credit spread to the discount rate. And also on the DB and the IB side, most competitors use US GAAP SOP 0301, which is based on stochastic, historical, and not mark-to-market scenarios, and hence offers a degree of smoothing in falling markets. And finally, we are alone in reflecting our attribution results in underlying earnings rather than in net income. You can see on the chart in the bottom of this page, I've given you the full 5-year position. One thing worthy of note, you'll see the change to earnings in financial year 2008 as a result of the basis risk, and this has been well managed since as a result of the actions I mentioned earlier. Looking forward, I do believe we're very well positioned for growth, and we're very happy with the progress, particularly on our mix of business. As you can see on the variable annuity side, 40% of sales now come from newly launched products. We've expanded our VA platform through these new products and are capable of meeting the needs of a wider client base. Our retirement cornerstone is getting some traction now, accounting for about 1/3 of our business at the expense of the fixed rate accumulator type business. On the life side, in addition to us recording 40% growth in the year, the mix is improving. You'll see that we still do offer term business, which is low margin in the US, and it's used by us as a door opener and a way to maintain relationships with our main distributors, and it has now fallen to only 17% of sales. A big success for us has been the indexed UL, which has grown from 5% in the year to 41%, principally through third-party distribution. As a result of all of this, the new business margin for the year, reflecting the improved mix, has improved 1 percentage point over last year to 13%. So we have decent margins on our business. We have the benefit of aligned distribution. AXA Advisor now accounts for 2/3 of our new business, and some good momentum with us. We are well positioned for growth. So in summary, in line with our objective to deliver sustainable earnings and free cash flows, we continue to enjoy a strong presence in the US, the world's largest profit pool for life insurance. Through our multi-distribution platform and our large in-force client bank, we are well positioned to grow. We have very strong and disciplined risk management capabilities, both on our in-force and new product development. We are seeing strong momentum, particularly sales on our life business. And our objective remains to increase earnings and increase free cash flows. Thank you for your attention. I'll now pass on to Veronique.
Thank you, Mark. Good morning. I would like to update you on where we are at the end of 2011 on our expense savings. As Henri mentioned earlier, we are on track with our efficiency program. And I would like to give you 2 messages. The first one is that we have the right governance to monitor this plan. And the second one is that the entities are executing the plan. Now, let me underline what are the key figures of Ambition AXA. On the efficiency program, we communicated in June that we will achieve in mature countries 1.5 billion euro of savings. 0.1 on P&C and life and savings administrative cost, and 0.4 in P&C in acquisition cost, a ratio. Where are we now in 2012? Our target in 2011 and 2013 was 600 million. We have achieved, at the end of 2011, 200 million. On the P&C acquisition cost, our target is 400 million, and we have achieved already 100 million in 2011. So 2,000 million in administrative cost and 100 million on acquisition cost. Now, how have we achieved these numbers in 2011 and what we will do in 2012? If you remember, we announced in June that we will keep our administrative costs flat, beating both volume growth and inflation. To achieve these 200 million of savings, we have used the 3 levers that we identified back in June: operational performance, external spend, and IT. On operational performance, this will represent 62% of our savings, which is around 150 million. What we have here is we have done several things. We have deployed lean management in France and in Belgium. Lean management is about process improvement and savings, but also this includes and involves all the middle management and the various staff in the department. The second thing is we have achieved productivity initiative in the UK, in the US, in Germany, in Medla, and in France. And third, our offshoring plan in France continues as expected. These three initiatives, lean management, productivity, and offshoring, allowed us to reduce globally our FTEs by 1,300 people. On external spend, we are using two levers, which is commercial levers and also challenging the demand. On commercial levers, we are renegotiating the pricing with our vendors by globalizing our volume. The second one is we're challenging the demand in order to reduce the volume that we purchase. This allowed us to reduce our external spend, and we achieved 50 million, which is 22% of the 200 million. On the technology side, you remember that we said that we want to protect our investment. We are still investing in 2011 1 billion. At the same time, what we have done is we have reviewed very thoroughly our infrastructure expenses. We have benchmarked ourselves against a world-class IT provider on the market, and we have looked at the opportunity to do a full outsourcing deal. We didn't want, finally, after due diligence, to do it because we believe we can do it well internally. We can do it well with selective outsourcing to create good competitions amongst our key vendors. And also, what we wanted to do is we wanted to keep the knowledge and the control of our infrastructure. But we have designed a plan that we have started to implement. What is the outlook of 2012? We will continue lean management program in France and in Belgium with new waves in the various entities. We also have started the same process in Japan, in Germany, in Italy, and in AXA Technology Services, and that will continue to deliver results. The second point on the external spend, we will be using the same levers, commercial levers, and challenging the demand, and we will apply that at four main areas: IT software, IT and professional services, and real estate. On the infrastructure side, or on the IT side first, we will continue to invest as we have invested in 2011 in our businesses. We will start to deliver on our infrastructure and transformation plan by really using four different levers: mainframe consolidation, server virtualization, new desktop technology, and network. This is what we have done in 2011, which means that we have kept our administrative costs flat, beating both volume and inflation, and we achieved 200 million of savings. What have we done on the P&C and acquisition ratio? What we have achieved in 2011 is a decrease of the acquisition ratio by 0.5, which takes us from 18.2 to 17.7. How did we do it? We did it using three main levers. The first one is the commission renegotiation, and we have done that in the UK with the brokers and in Spain with the agents, and that led us to achieve 0.3% of the acquisition ratio decrease, which is the equivalent of 60 million. The second point is also we have been able to contain our distribution expense flat in the UK and in Germany while volumes were increasing. This led us to a 0.2% decrease of the acquisition ratio, which is around 40 million. And we also worked on our product mix in Belgium and in Germany in order and with a greater focus on business with lower commission rates. 110 million of savings through acquisition cost, and we have used 3 levers: commission renegotiation, optimizing the sales and marketing cost, and also changing our product mix. Now, in summary, I want to give you 3 messages. The first one is we have, as we told in June, a clear plan. We know how to execute it. We are in implementation mode, and we have generated good savings in 2011. We have also good prospects for 2012. The second point is that we have the right tools in place to monitor the implementation of the plan on a quarterly basis and take corrective actions if necessary. And the third point, but I think you heard it through the various presentations, AXA is fully mobilized to deliver this Ambition AXA efficiency program under the leadership of the CEOs. Thank you very much, and I will now leave the floor to Henri, who will conclude the presentation.
Thank you, Véronique. A few concluding remarks. On 2011 first, I think the 2 key messages are very simple. The resilience of the business model enables us to maintain the dividend. The resilience of the business model is built on the results, the cash flows, the strength of the balance sheet. First message. Second message, we are delivering on the operational initiatives from Ambition AXA. This is reflected through improved margins, both in life and in property casualty. We have demonstrated the ability to manage the capital with agility. We have repositioned very substantial amounts over the last year. And last but not least, as Véronique has just explained, we are very well aligned with the efficiency efforts. It's demonstrated in 2011, and this enables us to look at the future with a reasonable degree of optimism in this very uncertain world, but before all, to be convinced that we have focused on the right things to develop the business in this uncertain environment. So going forward, what are we going to do? We are going to continue to implement what we had decided to do within the Ambition AXA framework. We want to maintain the agility which has characterized the last 2 years, and this is going to be aligned along the 3 big pillars of Ambition AXA. Selectivity, and what do we mean by that? We want to grow protection and health. We want to extract more value from the life and savings business by managing the in-force books, which are very big, more actively. And we want to foster growth in the direct business. Acceleration, we want to foster growth in the direct business and accelerate in the emerging markets further. Last but not least, efficiency. We are going to continue to deliver on cost savings. So this is for the operational side. More selectivity, a better use of capital. More acceleration in the places where you have a combination of volumes and margins. And reduction of costs. Of course, we will continue to maintain a very close eye on the balance sheet and the cash flows, because this is essential in these uncertain times. Overall, what we think is that the strategy is well suited for the current environment, and that this is going to enable us to grow the operating profit going forward as we think we can grow it. That's what I wanted to share with you as a conclusion, and we are now going to answer the questions. We will have questions both in the room and through the net. I'll take first some questions in the room. If you could raise your hands, introduce yourself, and ask your question. Emmanuel Calles.
Yes, ladies first. Emmanuel Calles from Société Générale. 2 or 3 questions, please. First one, maybe on the US, on the lapse rate, page 53, you mentioned the sensitivities of underlying earnings if a change in lapse rate. But what I did miss, what is the lapse rate current, the central assumption today? I could not find it in the slides. What is currently the lapse rate?
Mark, do you want to
Sure.
answer that?
We don't give out a single figure lapse rate because it is, our reserving is done on a dynamic basis and it depends on duration of the policy, it depends on in the moneyness and where interest rates are, so it is dynamically moving. So we've given you there a couple of key messages. Firstly, we've moved our reserve assumption to actual experiences this year as against the 3-year moving average. So the charge of $211 million, which is roughly in line with $150 million guidance we gave in Q3 last year, reflects the actual experience share and a one-off element for the catch-up. And then a rough movement of 50 basis points permanently below that, below the dynamic assumptions, would move it by $160 million.
Okay. The second question is on the BNP shares. You say you hedge BNP shares. Are you currently hedging end of January, February?
Denis or Gérald, do you want to answer that?
Yes. As far as the BNP shares are concerned, like all shares, we have some hedging, but we don't have a full hedging, and it could be we have, you know, in accordance with Solvency II today, it's with the economic capital, our interest is to, in order to limit the capital, is to have some hedging like protections, put protection and so on. Yes, we have, but it's not at all fully hedged.
And on a related question, on your equity hedging, you, as far as I understand, you made a loss in H2 because you had a loss of 100 million in H1.
No, it's
How
not.
does it come? Because market were strongly down in Q3. You should have made a profit in H2, no?
No, it's not a loss. It's only a strategy which had consisted in instead of keeping some equities exposure, to buy some premiums, to keep some upside, because again it's cheaper to buy some options which are out of the money rather than keeping some exposure in equities. That explains why, and this corresponds to time value.
And the last one is more general. It's more on regulation and on SIFI, systemic financials. It looks like insurance companies could fall under this burden. What's your view? I mean, the insurance lobbying has lost a battle here because it's a nonsense.
No, I mean, first, I think there is a lack of clarity on the process. I've also heard that some insurance companies would be, considered as SIFIs, mostly because of their size. I think we have won the argument that by nature, insurance companies are not systemic risks. They can be affected by systemic events like many other players. And I think the regulators are starting to understand better that the banking model is pretty different from the insurance model. I guess what they probably want is to have more an accrued transparency on the consequences from systemic events on very large groups, which is something you can understand. But I think progressively we are very clearly making the point that insurance companies are not systemic by nature. They can be affected by the consequences of systemic events, but they do not generate systemic events unless they do things which are not insurance, which are not in their business, like we have seen for some groups in the past. But this is certainly not the case for us, nor is it for most of the very large European players.
But we will not know the outcome of the current process until June or July of this year.
Thomas Jacquet.
Hi, good morning. Thank you very much. My first question relates to the new DAC accounting rule. Is it only an IFRS story, or is it impacting also the risk-based capital in the US? And can you elaborate maybe a bit more generally on the consequences of this change? My second is for you, Henry, is about flexibility in the perimeter of the group. You've been quite active in the recent quarters, selling activities. Is 2012 going to be a similar year with some disposals and potentially some reinforcement here and there? And my third question is for Nicolas Moreau. Paris is full of advertisement for a banking product sold by AXA Bank with a very aggressive credited rate. Can you give us some hints on the strategy there and the potential margin you expect from this? Thank you.
Thank you, Thomas, for spreading your questions evenly among the... Gérald, you start with the DAC.
Yes. With the DAC, to answer your first question, it has no impact on the RBC ratio in the US. That's the first point. The second is that, as you can see in the press release, so that's a new accounting rule, which is more cautious. So that means that today we have roughly 9 billion of DAC impact in our shareholders' equity, and we can expect that it will be a retroactive measure on the 1st of January 2012, and it will be a decrease of 2 billion. It's roughly speaking 50% concerns the US and 50% concerns the other countries being mostly France and also some countries in Asia like Hong Kong.
Nicolas.
Yes, AXA Bank is offering since the beginning of the year a rate of 5% plus 1 for new customers and and the same for existing customers. So this is a quite popular offer, as we've raised around 600 million net since this offer is up. This is a promotion for new clients for 3 months, and for existing clients from the date they put the money until the 15th of April. And the plus 1 is due only if the money remains on the account until the end of June. So it's really a 5 plus 1. So currently we estimate the value, the costs of raising the money to a little bit less than 1%. And we are in the process of building campaign to transform this into a life insurance policy. So we should in June put forward an offer for these people to move into structured products under a unit-linked structure. And the idea is to... what is interesting for us is that 50% of the customers are new customers for the bank. 50% is new money. And also for the networks, it's a very good activity. We've got in parallel also a life insurance product, which is called AXA Coupon Sérénité, which is 8 years structured product. And what is interesting is that both offers are not capitalizing themselves, because on the unit-linked side, we have had also, we will do 150 million euros of sales since the beginning of the year, so in 6 weeks, which is a good, for us, a good production. I hope I've answered your questions.
On the capital management, managing the capital with agility does not mean only managing the perimeter of the group. I think it's broader and deeper than that. It's managing the existing books, and that's why we are going to put more emphasis on the management of the life in force. We have the largest life in force book in the world. I mean, we are the first worldwide life insurer and the third largest one in P&C. So in life, we have the largest in force book. Most of the organizations historically are positioned for acquiring new business, and an insufficient attention is paid to the management of the in force, where you have potentially significant productivity gains, both in terms of earnings and capital allocation. So looking at the possibility of optimizing the in-force books by converting some of the products, by possibly selling some of the life in-force books, if you can do it at reasonable conditions, are things you have to look at. The other way to manage your capital with agility is to look at the way you price the new generations of products as far as the capital consumption is needed or is concerned. And from what Mark has presented to you, you can very well see that in one of the geographical areas where we are, I would say, largely exposed on the savings portion of the business, which is the US, the new generations of products are much less capital intensive than in the past. And this is a general trend. So in the first phase, you work on your perimeter and you sell what you see as non-core or non-essential. In the second phase, you look not necessarily geography by geography or company by company, but you look at the books and you decide what you want to do on the existing books and on the building of the future books. Maybe we are going to take one or two questions on the net. Two questions. First one, please.
A question from Farouk Hanif, Morgan Stanley. What is your latest view on the timetable for Solvency II, and what do you expect in terms of changes to the model once the current consultation is completed? And do you think these changes will still be positive compared to KISS 5?
Okay, very good question. We all know that there are rumors about a possible postponement of the implementation of Solvency II. We are fighting against that because what is bad is to have a very large sector, and insurance is a very large sector, contributing to financial stability and economic growth, having to live with two different systems without any clarity, neither on the timetable nor on the principles of the future system. So what we want, and it's not we AXA, it's we, the European industry, is first clarity as soon as possible on the remaining open issues related to Solvency II, and firstly about the implementation of the contracyclical premium, which we think is going to be more favorable than what was in QS 5. So clarity on the principles as quickly as possible, because the worst thing is to live with uncertainty without knowing when the new system is going to be implemented and without knowing what it is. On the timetable, of course, we would like the European authorities to stick to the initial timetable. If it's postponed by a quarter or two, it's not going to be a drama. But the worst thing, once more, would be to live with uncertainty. Next question.
Question from Oliver Steele, Deutsche Bank. Is the sensitivity to US lapse rate a one-off impact on earnings, or is it a per annum impact?
Okay, Mark, do you want to answer that?
Very simply, the sensitivity we gave would be a one-off impact.
Do we have other questions?
Yeah, a last one from James Cook, Scottish Value Management. Surely it would not be in AXA shareholder interest for Henry's ambition to stretch to worrying about Nescafé, Kit Kats, and shredded wheat.
Maybe a word on that, because it seems to be a coded language. I'm going to join the Nestlé board. It's the first board outside AXA. The first board position I'm accepting. I've done it because Nestlé is, I think, a phenomenal success story globally. It's a wonderful company, and I think it's very interesting for me as a CEO of AXA to understand how a company has managed to achieve covering essential needs for its clients, a 6% yearly organic growth over a very long period of time, and has achieved to build a unique brand, delivering a very significant premium and delivering very good margins to its shareholders. These are challenges which are very similar to the ones we are seeing for us, and I'm sure I will be learning a lot, and I hope I'm going to contribute. This is the answer, and be sure this is not going to distract me from my attention for AXA. Another question in the room before we close the session? No? If no, thank you very much for your attention.